Hola, buenas noches. Damos un par de minutos más para que se conecten algunos que faltan para empezar la clase. Okay, I think we can start now. Almost everyone is connected, so we can start with the class. Good evening to everyone. Today we will continue with the case study that we started last class. Hopefully most of you attended last class, so it will be easy just to continue. And then we will start with our first class regarding an M&A pitch. Okay, we will go into further detail once we start with the following class. I will share with you, there's some people asking for me to share the document. I'll share it with you right now, and we will continue from where we stayed. Actually, everyone already has this document because I shared it with you via BlackBerry after we finished our second class. So you already have the PDF or the PowerPoint document, okay? I'm not sharing it right now because I prefer that you can have a good video signal and that you can see me at least a few minutes and you can get to know me a little bit so that it makes a little bit easier this learning online, okay? So just during when I share with you documents, I remove the video or the camera because it's been a recommendation from our IT group saying that the quality of the video makes people with poor connections, or if anyone is not having the best connection, it makes they're not able to see well, or the Blackboard doesn't work as well. So I'll speak with you with the camera on, and when we review documents or view videos as we've done in the first class, I'll close the camera or I'll stop the camera, okay? So last class, I think it worked quite well. If you have any questions, let me know through the chat, and I will try to answer them as we speak. And if not, when we finish the case study before starting the new class or the new document, I'll be open for questions as well, okay? So we'll start from where we stayed. As you should remember, we were discussing the Maestro or Falabella Maestro case study. We had reviewed in some detail press releases or press information. We reviewed as well the press release or the statement by the company. We discussed briefly how it's interesting to be aware of the situation of the market, so understanding the business segment and the trends in the industry in the specific place where the transaction is taking place. So we were reviewing the home improvement market in Peru at the time, and we were discussing or reviewing a report done by Apoyo. And what was remaining from the case study was that we will review today was the insight from a buy-side perspective that I told you I was going to tell you, since at that time working at an investment bank that was advising a potential buyer, so advising on the buy side of a transaction that unfortunately was not the buyer that ended up acquiring. We were not advising Falabella, we were advising an international player that was interested in acquiring Maestro as well. So I will give you some insight of the process from the view of the advisor and the view of that potential buyer, and we will finish the case study with some analysis done by research analysts. Okay? So I'll share with you the document that you already have, as I told you, but we will see it on the screen so it's easier for everyone to follow. Okay? Okay. Just briefly, this is the document we reviewed last class, just briefly to remind you of the typical M&A process or schedule. We said that typically an M&A process is divided in two phases, and that these two phases can be identified clearly by the end, or more or less the end of the first phase is with a non-binding offer, and the end of the second phase is with a binding offer. And approximately, we said it lasts maybe 6 to 8 months, a typical process, okay? And the longest part is the due diligence phase, where you do a final analysis of the company before submitting a final offer. Okay, so important to bear that in mind in the context of the case study that we are reviewing. So we saw some information on Maestro. We discussed the press information on the news run that we did to understand better both the company and the transaction, or comments in the press. We saw the press release coming from Falabella, the acquirer, which is a listed company in Chile. And then we also discussed briefly the home improvement market at that time in the country. Okay, so we saw the players, how it was growing in the previous years, but had a little bit slowed down the last year. How did it behave? How did Maestro behave compared to the competition? We also saw more or less the margins or the EBITDA levels that they were generating. And there we we stayed there, okay? So now, as I told you, we're going to review briefly the process from the buy-side perspective, okay? So this is a little bit of what I can share with you of my experience working in that process. That obviously I can share because there is a lot of confidential information that cannot be shared, okay? But so you have an idea, at the end of July 2014, Enfoca launched a competitive process for selling Maestro, okay? You remember already the dates. It was in the mid-September that the company or the transaction was announced, okay? And what happened, okay? So potential buyers were approached by the advisors of Enfoca, and they gave us a process letter and a presentation, okay? They told us verbally that only a number of limited groups were contacted, or only a limited number of potential buyers, so it was going to be a relatively small process. It was going to be only a one-step process, okay? And here, this is extremely important. When we discussed the schedule or the M&A schedule or timeline, I told you, and I just recently emphasized as well again, that a typical process is a two-stage process. One ending with a non-binding offer, and the step two ending with a final offer, okay? So if you're participating in a process, either on the buy, obviously in the buy side, and they give you an indication that is very different from a typical process, you need to start asking yourself questions, okay? Why are we only having a one-step process? What is happening? This might give you some ideas, some indication, some information about what is happening in terms of competition, what is happening in terms of the company, the situation of the company. Why are they choosing to have only a one-step process or one-stage process if what typically happens is a two-stage process with the required timing in order to be able to analyze the company, assess the transaction, and do all the required things you need to do in order to do or feel comfortable with an acquisition. This typical schedule, as I explained or as we discussed briefly last class, needs 6 months or 8 months because there are some minimum things you need to do in order to be able to acquire a company. You cannot acquire a company without doing the proper financial analysis, without doing the proper legal analysis or due diligence, and also in terms of tax, accounting. You need to do a thorough analysis of the company to make sure that you are buying something that corresponds with the value that you are paying for. So you don't buy something and then have a surprise. So first big indication, when they tell you we're doing a one-step process, you need to start just asking questions. Why is this happening? And they are saying also that their intention was to sign agreements by the end of August. They were contacting us in July, and it was mid-July, if I'm correct. Okay, and they were saying, okay, in less than 2 months, we're expecting to sign definitive agreements, or so to have a final binding offer, okay? They were considering to sell 100% of the company. They had hired 2 financial advisors, Morgan Stanley and Merrill Lynch, okay? Another indication here, if they're trying to do a fast process, a quick process, that where they intend to sign agreements in less than 2 months, they're hiring 2 advisors, which is also a little bit unusual, okay? They are saying that there is only a limited number of parties. If you want to sell a company and you want to sell it well, you need to have competition, okay? This is rule number 1. So if you don't have competition in a process, then you probably will not be able to sell properly the company. If you don't have competition, at least you have to give the idea that there is competition. If not, the buyer will have the handle for, will manage the process, will have the negotiation capabilities, and you will not be able to sell it as well. So in order to sell well a company, you need to generate competition, okay? And you don't want to be having a failed process, so you want to do a right process, which includes all the required steps for the potential buyer to feel comfortable to buy and feel comfortable to pay well for a transaction. And you want to make them feel they are competing with others so that they can raise price and they can actually pay, hopefully, better than what you're expecting, or pay more than they are willing to pay because they know there is competition, fighting with them to acquire this company, okay? So some indications on the process there. 2 advisors, a short process, very fast signing of agreements, and unlimited number of parties, okay? What did we know about competition? So based on our local intelligence, speaking with people we knew in the industry, our clients in other countries, who we knew was interested in potentially in Maestro, what we thought was that the better positioned participants in the process were Falabella and Cencosud. And it is not very difficult to imagine that those that are the best placed to compete or to pay are the local players. Why? Because both Falabella and Cencosud, Falabella through Sodimac and Cencosud through Promart, had already were competing with Maestro locally. So since they're local players and they're in the same industry, obviously we thought they could have significant synergies, as opposed to a third party coming from, or an international player coming from abroad with no operations here, would have very limited synergies. And for those that are not familiar with the synergies, or synergies value, is any benefits that you can get from, for example, cost savings or additional revenues for already owning a similar business or for already managing a business here. For example, if you are a local player that is going to be acquiring another local company in the same sector, probably many of the corporate positions are going to be doubled, and you can reduce or work the same, a new business or an additional business with very limited or few additional corporate positions. That is a source of synergy. If, for example, that is a cost synergy. If, for example, you are a player that is already participating in the market here, for example, imagine Sodimac or imagine Promart, and they are selling the same products as Maestro, but Maestro is selling those products at a higher price, or you are selling them at a lower price, or inversely. At the time you acquire, you can sell them at the same price, and you don't need to be competing with the other, and then you have you could have additional revenues, and those additional revenues would be revenue synergies. So additional income you can have from sharing the businesses. Okay, let me quickly answer a question. When you are making the evaluation to sell, do you consider synergies? Okay, so typically what you do when you do evaluation of a company, you do evaluate a standalone valuation. You want to know what your company standalone is worth, okay? But one thing is the valuation of the company and how much you expect your company to be worth. And another thing is the transaction price, or the price at which you can effectively sell your company, okay? So for valuation, to understand the implicit value of my standalone company, which is based on the future cash flows that I can get from that company, will be standalone. I will consider synergies if I want to know how much another company might be able to pay. So for example, I could say, imagine just we use general numbers. Maestro, imagine that my valuation of Maestro is 100. And I know that between Falabella and Maestro, there will be a lot of synergies. And I will show you in another class how we value synergies, etc. But we can say, imagine synergies are worth another 20 additional million based on some estimates that I assume. So I know that Falabella could be able to pay 120 million. Obviously, Falabella is not going to be willing to pay away all their synergies. They want to pay at only what the company is worth, and they want to keep that value for them to extract in the future for them. But if they see that there is competition, they might be willing to share a little bit of that value with a seller in order to secure the transaction for them. For example, they might be willing to pay 105 or 110 and remain with the rest of value from the synergies for them, and be more competitive than a potentially an international player that has nowhere from where to extract additional value and would be overpaying and putting themselves in a difficult position because they're paying more than what really. Okay, we will go into a lot more detail when we go when we do the class evaluation and when we do the class in transaction and synergies, but just so that you have an idea. Okay, so who did we think was best positioned? Falabella and Cencosud with synergies, but we also thought that parties that could be potentially interested could be Advent, that there is a private equity group that owned similar company named Quero Quero, Grupo ADO, Homebase, Kingfisher, Saint-Gobain, Home Depot. We knew many groups that could, international groups that could potentially be interested in entering the Peruvian market at that time as well. Okay, so we had this approach in July. They were expecting closing the transaction by the end of August, but they told us then, we asked for a meeting with management. You typically during a process have management meetings in the second phase, and you typically have due diligence sessions, but they weren't offering this in their process letter. So they told us that senior management could meet briefly with us on September 2nd, and we had a meeting with the CEO and the CFO, and they had no presentation prepared. So this was very suspicious. You're going to a management presentation and there is no presentation ready. So we thought, look, there's something really strange here. So what do you think was happening? Who has an idea? Why would they do a short process? Why would they try to do a transaction without all the appropriate steps? Why would they call us or why did we ask for a management meeting? Obviously, you are not going to be acquiring a company and not even meeting with management. You're buying a company, including their management. You want to meet them. You want to make sure that you like them. You want to make sure that they give you all the information about their outlook, the trends, how they see the future of the company, so that you can do properly your evaluation. So all of these are indications telling us, look, these people, they are selling the company to someone else. They're doing a really quick process, or they are already very advanced with someone else. And what they want us is to generate competition here. So this is not a serious process for us. This is what we were thinking, because they were not obviously giving enough time. Or the other alternative is they might be interested. They might think that we can move very quickly because we are a player that knows very well the sector, and we might be willing to assume many risks, and that being the price to pay for entering a new market where there is very scarce competition or limited players. Okay, and then on September 10th, we as a buyer submitted an offer. Okay, we obviously submitted an offer, a fair offer, based on the valuation of the company. I'm excluding the multiples consider because this is obviously private, but we had some obviously conditions for this transaction. We said, okay, the consummation or the closing of this transaction is depending on reviewing the contracts, completing the due diligence, because we had done a very short or small due diligence, and also requested exclusivity. Okay, so these are some details we will see afterwards, and you will understand better, so that you have an idea what was presented. Okay, so here is a little bit more information of the process from the outside, but basically what we discussed before. So one brief process in one stage, direct access to the VDR or the virtual data room, and presentation of, and it wasn't really presentation of management, it was Q&A with management, a very limited due diligence, and they asked for binding offers directly. Okay, so what happened? How did the advisors or Maestro react to our offer? Okay, we presented the offer on September 10th. On September 15th, they told us, look, we are in very advanced conversations with another potential buyer, and we are discussing a price that is significantly higher than what you have presented, and they have only asked for a limited confirmatory due diligence, while you have asked for a longer due diligence requirement, and they have a better markup of the contract. So better comments or less comments to the contracts than you provided. Okay, so obviously here we confirmed that they were obviously had been discussing with someone else and that they were pretty advanced. Obviously, if they have a significant higher price, this made us think that it was either Falabella or Cencosud. And we asked our client if they were willing to offer a much higher price than they had done, because obviously the local players were probably paying part of their synergies, and to which our client said no. So we stopped there. And 2 days after, Falabella announced the acquisition of Maestro for the details that we saw last time. So a total consideration of 492 million. If this is equity value, if we add the net debt, it is approximately 720 million. And some key statistics only looking really at a higher level. The enterprise value or firm value divided by EBITDA was 16 times. The enterprise value divided by sales was 1.3 times. And this implied almost a 28% IRR for Maestro, or 2.6 times money on money for Enfoca, so for the sellers. So a really good transaction for Enfoca. They were selling at an IRR of almost 30%. And at a very high multiple for the industry of 16 times. Just for reference, in this industry, probably ratios of 10 to 12 times make a lot more sense than 16 times. Okay? The price assumed included the excluded assets. These were the land bank or the land. Remember that we discussed last time that when they denied that they were selling Maestro, where the CEO came out to say that they were not selling, they said that they were only thinking of selling some land bank and some pieces of land, and that they were selling it for 70 million or they were worth 70 or 75 million. So this price includes this land bank, and that it was going to be fully funded through international loans. Okay, so why did Falabella pay this price? They were going to be able to control the home improvement market. Obviously, this is a modern channel we're speaking about. Also, think about Falabella. They had many retail formats. They not only had Sodimac, they had Saga Falabella. They also had Totus. So if they acquired Maestros or land for the construction of the Maestro, they could use it not only for putting other Sodimacs or Maestros, but also some other formats of their stores. If they acquired Maestros that were located in similar locations than their Sodimac store, they could use it for another type of store. For example, they could use it for a Falabella, so they had many synergies from that transaction, besides the most evident ones that are the cost synergies and the revenue synergies we discussed before. Okay? Here you see, no? So flexibility of having different formats instead of store closings, potential revenue synergies, and the Falabella shares at that time were trading at 16 times EBITDA. So they acquired at the same level 16 times that their shares were trading. And why is this reference important? Because if you acquire a company at a higher multiple than the multiple at which your shares are trading, then it's going to be a transaction that is dilutive for your shares. If you acquire a company that is trading at a lower level, then it's going to be accretive. Okay, so it is not good, let's say, for shareholders to have for your company to be acquiring companies at a higher trading level than your own, because it's going to be dilutive for your shares. Okay, so what does this acquisition imply for Falabella? We said already very high market share, around 80% in terms of sales, in terms of market or selling space. They practically closed the market for any new competitor. Okay, so this was key for them to make a transaction. They didn't want an international player to be coming and getting a large chunk of the market where they were already the largest player. They wanted to secure their market and close the market to other large international players that could come and start price wars with them or strong competition with them. Okay, so they could obviously pay a lot more than some others because they had different interests as well. Okay, what was the market reaction? Maestro's bonds, as we saw last time, saw this positively, and the Falabella shares as well. They increased 2% in a couple of days. Okay, so okay, what were this? I think we discussed most of it. I want you to see here some of the views of analysts. Actually, I can show you better these reports, because it's important also that you learn, if you haven't seen before, broker reports or broker notes, as we call them, or analyst reports. It's good that you start getting familiar with them, because they are very interesting and useful documents. Okay, so let me show you a couple of broker reports after a transaction. So let's see what JP Morgan was saying. So JP Morgan, this is a broker report of JP Morgan following Maestro. So there can be brokers analyzing either Maestro or Falabella. Since both were listed companies, they both had broker coverage. Okay, Maestro not only because of their shares, but also because they had this international bond, so they had more coverage. Okay, so remember last time we discussed that Maestro was not going through a very good situation because they were very highly in debt, and the market conditions for home improvement players that year was not as good as the previous years, and they were more or less struggling. Their bond was suffering as well, and there were some rumors in the market that they were going to be downgraded, that they were not in a position to pay, and others. Okay, so what is JP Morgan's comment on the transaction? They say Falabella saves the house. Move to overweight despite rally. Okay, so they say Falabella announced the acquisition of Maestro for approximately 485 million, 1404 million. You will see many different figures because the figure that was reported was a figure in soles. So depending on who's doing what exchange rate they are using, they might be coming up with different values. Okay, so don't really worry about that. One is saying 482, another one is saying 485, but the disclosed amount was 1404 in soles, plus debt assumption. Falabella will be financing the acquisition through a syndicated bank loan and will request an increase. The buyer is one of the largest retailers in LATAM with revenues of almost 14 billion. They're giving some information on Falabella because it's coverage for Maestro. So those who follow Maestro not necessarily know Falabella. Okay. In comparison, they give Maestro figures, revenues and EBITDA. After opening 6 new stores in the past year, Falabella had a total of 25 improvement stores in Peru, while the target had 30 locations. Consequently, this acquisition should almost double Falabella's selling area in the country. What else are they saying? We see this acquisition as positive for Maestro, given the company's high leverage and liquidity concerns, what we just discussed. So, Maestro had 6 million in cash versus 16 million in short-term debt, so the situation was not that good for them in terms of liquidity and debt. Leverage had increased significantly in recent years, and the company had expanded aggressively and opened new stores. Given the relatively slowdown in the economy and tougher competition, top line, so sales did not grow in line with expectations and margins deteriorated. The adjusted net leverage reached 5.9 times, and it should be, everyone should be more comfortable at around 2.53 max, and the company struggled to generate positive free cash flow despite the material capex reduction. Okay, we believe that results will likely improve under Falabella's management, especially considering that Sodimac is Maestro's main competitor. We estimate that the pro forma entity will have over 90% market share in the market in Peru. There is execution risk, but given Falabella's solid track record, we believe Maestro's performance and credit metrics will improve on the back of this transaction. Therefore, we upgrade the recommendation on Maestro to overweight. So they see very positive that transaction. Okay, there are some more details I can share with you, these documents, but I think I read what is most important and that you are able to see also a broker note. I will show you one other broker note. So you see a view from the other side. Let's see this one from Morgan Stanley. Okay, so Morgan Stanley is following or is covering Falabella. Okay. What is their view on what are they commenting on the acquisition? They say Falabella acquires Maestro. Impact on our views. We see positives from Falabella's purchase of Maestro, but a full valuation. So basically what they're saying is we see the transaction as positive, but we think they paid full value. Okay. The acquisition increases Falabella's sales mix both to Peru and to home improvement, Falabella's strongest format in our view. Falabella doubles its market share in home improvement in Peru's fragmented industry to 15% and is now the clear market leader. Here they are including both the modern channel and the traditional channel. This is why market share figures are different. Though Maestro was heavily in debt and struggling more recently, its operations appear strong and profitable, and there likely is room to run the combined operations more efficiently. That said, the deal multiple appears full at 15 times. Remember when we did the calculation on the buy side, we had estimated 16 times. It can be because they're using 2013 and we were using maybe June 2014 figures. But here is interesting what they say. They say a full multiple at 15 times or 13.9 times, excluding the land bank. What are they doing? They're saying, okay, the value that they paid divided by EBITDA, but they're excluding from the value that they paid the 70 or 75 million worth land, because they could say that this land can be sold separately or has a separate value, and that really they are paying the 1,404 or the 492 million for the implicit EBITDA of the business, and that would give a multiple of 13.9 times, which is obviously much lower than the 15 or 16 that we were discussing. What else do they say? They say Falabella bought 100% of the shares of Maestro for $492 million, plus the assumption of $222 million in debt, I assume, or net debt, for a total transaction value of $714 million. In addition to the store chain, they are buying a land bank of 119,000 square meters, valued at $70 million. So this is what I'm saying. They are excluding from the 714 the 70 million, and they are calculating the resulting number divided by the EBITDA and coming up with a 13.9 instead of the 15 or 16. Maestro is Falabella's main competitor in Peru with 30 stores. They're giving some financial figures, and they are talking about Maestro's in-debt position. They are saying the transaction multiple is above the 11.9 times that Falabella paid to buy the ciclo chain in Brazil last year, but is in line with its current trading multiples of 16 times. Okay, so basically what they're saying is they're paying more than what they paid, or what is typically paid in the industry that I told you, that is between 10 and 12 times. They're paying more, but if you exclude the value of the land being paid for that is not used for the home improvement business, then you come up with more decent multiples, more in the 13, 14 times range. Okay, so interesting analysis from this broker. One last broker comment before we continue with our next lesson. Let's see, Santander. What is Santander saying? Santander is covering Falabella as well, similar to Morgan Stanley. And what are they saying? Are they giving us any other interesting, useful comment? They're saying, Maestro acquisition for Falabella, not a bargain, but positive optionalities. So they agree with Morgan Stanley that they paid full price. They didn't pay cheap for them, but it gives them optionalities or outlook or interesting future. Okay, what are they saying? They're saying, on September 17th, Falabella acquired 100% of the shares in Maestro for $492 million. In our view, the acquisition makes strategic sense and has lower risk than entering markets in which Falabella has less experience, though we believe the valuations are far from being a bargain. However, when asked for store maturity, the potential value of the land bank, and lower cost of debt, we believe that the transaction seems more reasonable despite the execution risks. So again, they are doing some adjustments to the value of the land bank and the cost of debt at which Falabella can finance themselves compared to Maestro, and they are seeing additional synergies there. and they're coming up with a different multiple. Okay, so according to our estimates, Falabella is paying 16 times firm value to EBITDA at a premium to Falabella's current multiple. We know that Maestro has aggressively opened stores. The company has opened stores, increasing sales by 93% during the period, decreasing, however, sales per square meter is just below Falabella's Sodimac operations in Peru. If we assume that Maestro will achieve the sales per square meters and EBITDA margin levels of 2011, the acquisition would be valued at 11.1 times EBITDA, not a bargain, but more reasonable. So they are doing a different analysis, and they are saying, if we assume the levels of a couple of years ago when they were not doing so many openings and they had a more stable position, we assume that you can reach those margins and those sales, the similar levels of sales per square meter, we would improve significantly the EBITDA, and the implicit multiple would be of 11 times. Also, they're saying real estate, another source of hidden value. On September 10th, Maestro debt was downgraded by Fitch from B+ to B on the back of its relatively high debt levels, adjusted debt to EBITDA exceeding 5 times, and deteriorating cash flow. In a press release, Maestro management mentioned that in the process of selling its land back for a value estimated of 75 million. So here again, this broker, similar to the other one, is excluding or would be excluding the 75 million or 70 million in the other case. Finally, reducing financial expenses could happen quickly with little execution risks. Prior to the transaction, Maestro's bond was trading at a yield of around 8%. Following the announcement, this amount declined to approximately 5.6%, another source of potential value from the acquisition review. So basically they are saying, at the moment Maestro is changing owners, the cost of debt is going to be decreasing significantly, and therefore this is a cost synergy for Falabella, which will improve the EBITDA level or the income level of the target, and it will bring additional value to the company or to the acquirer. Okay, so I think with that we are finished with our Maestro Falabella case study. I think you should have an overall view of what happened in the transaction. Now you read about the Maestro or Sodimac Maestro acquisition or Falabella Maestro acquisition. I'm sure you will understand much better what happened, and you will have a much better idea also, hopefully, of figures and multiple sources of value, competition in the process, and hopefully you start also understanding the dynamics in an M&A transaction from the sell side and from the buy side. In the last page of the presentation, you will find some of the market reactions, which is a summary of the different 3 broker notes that I just showed you. So some comments from Morgan Stanley, the key comments, some comments from Santander, and some comments from JP Morgan. Okay? So, as you can see, and I believe it's very interesting to analyze and to have all the different aspects of a transaction in order to assess properly or to understand well what happened in that transaction. So some key takeaways that we have from this case study. We can see that Falabella paid a full price or maybe overpaid a little bit for that acquisition, but it was in their interest to do so because they wanted to secure a market and they wanted to make sure that they were not affected or their business was not affected also by the entrance of an international player. they could extract a lot of additional value from potential synergies between the companies, and they were willing to share some of this value in order to secure a transaction and allow other players to compete with them in the process. What we know is that probably they were not going to be doing a full, complete due diligence because they knew very well this company. Obviously, they're in the market, they were the direct competition, so they had obviously to do a lot less due diligence than what probably needed to do any international new player that didn't know well the market, and they were willing to take advantage of this and propose the sellers to have a short process to let them put their best price, and they offered a very good price for doing so. Also, very interesting is that Maestro was not in a good financial situation. And typically what people think is when a company is not going through its best moment, maybe it's not the right time to sell it, because if it were doing well, you would be able to sell it at a better price. But look at what Enfoca did. Look at what Enfoca was able to do. They were able to sell a company that was in a very difficult situation, that had rating agencies downgrading their rating, that their financial costs were huge, that their liquidity was very limited. They were in a stressful, financially stressed situation, and they were able to sell very well the company, and having a potential buyer maybe overpay a little bit what the company was worth. And at the same time, they were able to secure a transaction very quickly, to have very limited disruptions in their own company, to have very limited disruptions in the target, because when there are rumors in the market that a company is being sold, employees start feeling uncomfortable, they start leaving their jobs or changing companies if they can. There is a lot of uncertainty. They were able to do it very quickly. They were also able to do it without having the sellers showing Maestro's information to many players. What I told you was that in our case, that we were advising a buyer, we received very little information on Maestro, and we were asked to submit a final offer with very limited information and with very limited due diligence. So they didn't share a lot of information, which you don't want to do either with groups that are potentially going to be competing with you in the future. Okay, so very interesting way of Falabella to manage the process, and also of Maestro, of Enfoca, and maybe one of the reasons to hire 2 investment banks and make sure that they did this very quickly, efficiently, in the best way, generating the maximum competition possible, etc. Okay, so hopefully with that you have an interesting idea of an M&A transaction. We will continue with today's class, actually, because this was part of the last class, where we will discuss an M&A pitch. Okay, so bear with me 1 second. I will share with you the document and close the camera. Okay. So we discussed last time the typical M&A schedule or timeline or timetable, and I told you that we would be coming back to this slide many times during the course. because it's very interesting now that you have seen an example of a case study. It's very interesting to understand or to get indications from the process to understand what is happening on the other side. You know that an M&A process, which has a sell side and a buy side, or somebody selling and somebody buying, you have very limited information on what is happening in the other side. And obviously, if you are a potential buyer and you have other buyers potential buyers that will be competing with you, you don't want them to know what your strategy is, how much you're willing to pay, if you're interested or not in the process. Because if there is competition, you will end up paying more money, needing to pay more money for the company that you want to buy. So it's not in your interest as a buyer to be providing or giving information on if you are participating in a process or not, if you're interested in the company or not, how much you're interested in the company, how much you are willing to pay. So usually these processes are very confidential because it's in the interest of managing well the process that you don't want the other side nor other players to know what is happening on your front, okay? So all that strategy, let's say, put aside, how does an M&A process or M&A process start? Obviously, or usually, it starts with some owner or shareholder, entrepreneur, sometimes even management, interested in selling their business or interested in selling a portion of their business if we're talking about management, okay? Obviously, it can come from the other side, a potential buyer interested in acquiring a business that is not for sale and doing the approach and trying to buy the company and putting a very interesting price on the table to try to acquire the company. But the typical M&A process that is structured, that is well organized in advance, etc., usually starts with someone in the sell side willing to sell. Okay, so what is the role of M&A bankers or M&A advisors? Advisors typically approach their clients either to propose them to sell their businesses and obviously to advise them in this process, or approach clients and propose them to acquire another business and proposes them to advise them in acquiring the business. Okay, so basically the M&A advisor or the M&A banker is the advisor for the seller or for the buyer in an acquisition or in a sale. Okay, if you see it from either side. Okay, and how is this meeting or this initial meeting between the advisor and the seller or the client and the advisor or the potential buyer or client called? It's called a pitch. And basically the pitch, P-I-T-C-H, is the document or the presentation that is prepared by the advisors or by the bankers and is presented to the client in order to present them the idea of what they could buy, or if it's a sell side, how to present them the possibility to sell their company. Okay, so this is what a pitch is called. Okay, usually in our timeline, the pitch happens before this internal preparation. It can be part of some initial meetings. Sometimes it doesn't even start with the advisors visiting, doing a pitch. Sometimes it starts with a client calling the advisor and saying, look, I'm interested in selling my company. Please present me a proposal or a presentation of how you see the market, who do you see as potential buyers for my company, how much do you think I'm worth, how would you see a process, and present me a proposal and your fees or your what would be your proposal for advice. So what we will discuss in today's class is what is typically included in these M&A pitches. So what is typically discussed between advisors and sellers or potential buyers in these strategic meetings when discussing the possibility to sell a company. Now we will focus a little bit more on the sell side, because we are going to be assuming in the next couple of slides that we are visiting a client that might be willing to sell their company, okay? So what do you typically discuss with them? So what alternatives does a seller have? Okay, we think they would be interested in selling their company, okay? And there can be many different reasons, as we saw last time, to sell a company. So what could be the options that they have, okay? Or what, depending on the situation of our client, what could be their interests? Are they, for example, owners of a business that they have grown and they started, that they have grown since the beginning, and now they are a little bit tired and they are willing to get their money and sell, and they're willing to sell 100%, and they have no children or no one interested in their family in following the business, or maybe they don't want their children to end up fighting in managing a business and they prefer to retire and leave their children money and sell their business and give them money to split between them. So their choice or their situation might be interested in selling 100% of the company. Another option would be interested in selling control of the company. Look, I think that this company is probably going to be worth a lot more in the future, but I'm already this is what the client could tell you. Look, I'm already very tired of managing the company. I don't want to be involved in the day-to-day of the business, but I really believe in the potential of this sector, of this company. I think it will continue growing. I would be very happy to stay in the company to continue to receive dividends or stay as minority shareholders, or they are willing to sell control. Okay, this is a second situation. What would be a third situation? A third situation would be, look, I am not willing to sell control of my company. I want to continue managing my company. I want to continue managing this business, but I feel that some strategic knowledge or experience would be very useful, because my company has started to grow and I don't really know where to continue, how to manage it. This started as a very small business and now it's something with a very large size. Maybe a strategic player would benefit from managing it, but I would like to stay. Sorry, I mean minority stake. Maybe I would like to continue managing, but I need some guidance. I need someone with experience, maybe managing these businesses in other countries. I maybe need a partner that is willing to help me, maybe financially. Maybe I want to grow, but I don't have the capacity or the financial capacity to inject additional capital in this company to continue growing, but I'm willing to open the ownership of my company to allow a financial player to come in, put money, and acquire a minority stake. And then finally, a smaller transaction, which is the last one, which would be selling only a business segment. Look, I have this company, it has 5 business lines. I'm not interested in this particular business line now. For example, I'm a food company. I'm producing sweets and, I don't know, biscuits, and on the other hand, I also have this water production. I'm not interested in continuing to selling water. Maybe I sell it to a strategic player that already produces water and might be interested in acquiring my brand, etc., etc. Okay, so they want to exit a certain business line, and which is sometimes a bit more difficult because there are many areas or that work for or either the corporation or many non-administrative areas that do the work for all the different businesses, and it's sometimes very difficult to split, but you have to consider all the different options. Okay, what are the dilemmas or the issues that the different sellers could have in different situations? So let's see. If they're willing to sell 100%, they might be thinking, is it the best time to sell my company? Is it a good timing? Should I wait? Or should I do it now? Can I generate more value for my company if it's managed separately, independently, etc.? What should they be thinking of? They should be thinking that if they exit the business, they are not going to be able to compete in this sector for some time because they're going to be having non-compete clauses. What if you're selling 100% of your company, you are probably, if it's an interesting sector, probably have a high number of interested players. Probably strategic players will be looking at your company because you're selling 100%. You are going to be getting potentially more money than in a minority stake on selling a business because you are selling control. So control has additional value. So imagine if you look at the share price of a listed company, the price at which the shares are trading, this value is the trading value of the company or the valuation or market valuation of the company. It doesn't include a control premium because it doesn't assume that you are buying 50 or more % company and that you will be controlling the company. If you acquire control of the company, there is an implicit control premium, which implies that your company is worth maybe 20, maybe 25% more only because of the acquisition of control. Also, if you are selling 100%, there might be some potential for synergies of other companies, or if it's strategic players buying, that they might have synergies with your company and they might be willing to pay more than your value. Okay, so this is the case in which you can get obviously more value for the company if you sell 100%. If you sell control, what are the dilemmas or the things that you should be thinking of? I will continue to participate, or will be able to continue to participate in the company's upside or the potential that we discussed before. I will be able to finance some investments to take the company to grow to the next level. And then also I should be thinking of alternatives if I think the partnership doesn't work in the future. So obviously thinking about signing a shareholders agreement. So you need to be thinking about a partial sale. You need to be thinking about your exit mechanism. How are you going to negotiate with those that are acquiring control? How you will be able to exit the company or sell in the future. If not, you might end up trapped with a minority stake in a company that you might not be able to sell forever. High strategic interest because you're selling control, the same as in 100%. You are going to be getting as well your control premium because you're selling control, and you're going to be benefiting potentially from the upside of the company, which you weren't here because you sell everything. Okay? In a minority stake, you can continue to participate. Selling a minority stake, you can continue to participate in the upside, but you will need to put capital for further growth. You could have a financial or strategic partner to add value to the business. So what should you be thinking of as well, or some of the characteristics for selling a minority stake? You are maintaining control of the business. Usually in a process you will have less number of interested parties because you are not selling control, and not everyone is willing to enter or to acquire a company with partners, and they will need to assess you and evaluate you and see if you are the right partner for them. You are going to be getting a lower price because there is no premium or control premium attached to the price because you are not selling control. And your partners or those who will be acquiring this minority stake will be asking for, similarly to the previous case where you were asking for a shareholders agreement with some exit mechanism, they will also be asking for a shareholders agreement with an exit mechanism, with some certain rights to be able for them to leave and to have some say in the company and some rights at the time of selling. Okay, this is a right of first refusal or a right of first offer, which are rights to sell your stake at different points in time that we will see in a lot more detail when we discuss terms of a contract, when you sell a company. And finally, when you're selling a business segment, what are you looking for? You're looking to exit a specific business line. So is it the right time as well to sell it or not? Is there a specific or strategic business you want to keep or you want to sell? This is obviously, as we discussed, a more complex process. It requires the separation of a company that is working as a whole. So it's obviously a very different transaction. There are some tax considerations to consider because it's not independent company, and obviously the interest or the potential interest from players in acquiring a business segment should usually be lower, but obviously depends on what the business is or what kind of company it is to see if there is potential interest from buyers in those sectors. Okay, what kind of investors or of acquirers, of buyers could you have? We have already mentioned the two large groups. We can either have typically strategic players, which are buyers that are already participating in that sector, that already that could be your competitors, or that could be players in other countries that already own or manage businesses in the same sector. Okay, these strategic players usually want to buy majority stakes or controlling stakes because they want to manage the company, because it's what they know how to do. They are looking for investments for the long term. They are probably funding themselves. They not necessarily need your management to stay, because sometimes, especially if they are already present in the country, they already have their own management, and when they acquire your company, they are going to probably merge both companies and remove some of the executives or management in the target company if they're obviously not better than their own management. And generally they can pay more in a process or in a transaction because they might have synergies, especially if they are in the same place. Okay, so what is the value that can be added in a transaction by a strategic player? They can incorporate the best practice or their knowledge of the business. They can have better access to financing, to funding. They can improve your negotiation power with suppliers if they're the same suppliers than for them, or they know them regionally, etc. They will probably have some business development alternatives, ideas, and probably you can extract some synergies from the transaction. What is a financial investor bringing to a transaction? What should be considered and what additional value do they bring? Okay, so usually financial investors acquire minority stakes or sometimes controlling stakes, but not necessarily 100%. Obviously, we're saying usually there are private equity funds that acquire 100% of the company, manage it themselves, they already have experience in the sector. But usually, in general terms, they are interested in a shorter term, typically 5 to 7 years, sometimes even 3 years, and they're going to be entering with a stake. Usually, they like the previous owners to stay or to continue either managing or staying in the board for some time. They obviously require exit mechanisms because they are buying to improve the company or extract value from the company and sell in a few years. Usually they come with funding, they have pools of investors behind them that can usually increase capital in the company to let them grow. They can also bring their knowledge to obtain good financing conditions and bring leverage to a company. They usually or most commonly require or ask management or owners or people important or relevant in the company to stay for some time at least. And usually they pay less than strategic players because they are financial investors, because they are looking to acquire at a low price to enhance and improve the company, extract value, and then sell in a few years. So they are looking to acquire more cheaply, and they're usually not competing or trying not to compete with strategic players. Okay? In terms of the value that they can bring, they can have more international experience or visibility. They can bring some experience for management if they already manage companies in that sector in other countries. They can strengthen and professionalize management in terms of they can bring business metrics, they can bring scorecards, they can bring best practices. They can implement some strategic and cultural changes if they think are relevant. They can have some additional access to capital, this we mentioned already. They might be bringing regional growth if they have presence in different countries. They are also highly interested in growing through acquisitions and probably have the experience. And usually they have better corporate governance or financial practices than small and medium companies that are looking for additional capital for growth, looking for financial investors. Okay, hopefully this gives you a better idea of who the typical players are. Okay, what are the types of processes that you could have? So, as well as discussing with potential sellers or your clients, the strategic alternatives that they have, selling 100%, selling a stake, selling a business, to whom to sell it, strategic players, financial players. These are all discussions that you should have if you are on the advisory side with your potential clients or with your clients to understand how to structure the process for them. And then, regarding the process, there are different types of processes as well. And the process obviously depends on the type of company that you are willing to sell, the level or the amount of competition, the number or the amount of interest that you see in the market, etc. So you can go from something very large, which is a public auction, so approaching almost everyone to potentially acquire a company, a competitive process where you have a select number of potential buyers that you approach and you allow them to participate in your process, or you can have bilateral negotiations with one or two players and not a full process. Okay? Obviously, each type of process has different characteristics, and let's briefly discuss the three so that you get a better idea of what are the options that you have in a typical process. Okay, so in a public auction, what do? You contact a large number of potential buyers and you distribute detailed information on the company, which you sometimes even do public, and you usually have 2 or 3 round processes in order to start narrowing down all your large number of potential buyers. Okay? In a competitive process, you have a limited number of buyers that you select, finger pointing, and usually it's a 2-round process, okay? As we discussed in a typical timeline, okay? This also helps you to define what type of process has been chosen and then what might be happening in the process. And in a bilateral negotiation, the buyers are ranked by interest and execution capability and different metrics, and then you select a small group, either 1 or 2. It's very difficult to manage. I mean, not difficult, but it's not very helpful to manage an M&A process only with one buyer, because as we discussed before, if you only have one potential buyer, you have no negotiation capabilities, and basically they can do whatever they want with you. And the only argument that you have is if you don't come back or if you don't behave in the process, then I will not sell the company. But these are not very strong negotiation tactics, okay? So ideally, you want to be a little bit more here, but obviously it depends on the nature of the transaction, which type of process you decide. Who are the potential buyers in public auction? They can be strategic and they can be financial. And what happens? Sometimes in public auctions, there are these very large processes and some competition. For example, financial players sometimes don't participate in this type of processes because since there is a lot of competition, they think it doesn't really make sense for them to participate in such a large process, because it will be probably strategic players willing to pay more that will be acquiring the company in the end. Okay, so for the competitive process, it's also controlled, sometimes focused on strategic players, but you might also want to bring some financial players to participate to potentially generate some more competition. And in bilateral negotiations, usually you choose the strategic players or the financial players that already participate in that sector. If not, they are not going to be willing to pay a fair price. Okay, in terms of timing, another timetable, 4 to 6 months. Here it says possibly less. I will say now, in current situation, probably more. 6 to 8 months, I think it's fair to say. Here in a competitive process as well, 6 to 8 months, I would say here, but maybe there is less time required for questions and answers because there is less players participating. And in terms of bilateral negotiation, it's, as I told you, difficult to manage a strict timetable because the potential buyers will have a lot of negotiation power and might be able to delay and manage more the process if they know they are alone. So ideally, if you're having a bilateral negotiation, it's good to let them think that they are in a competitive process and that they have other parties competing with them. If not, you will not be able to manage well a process and to structure them and make them comply and respect the dates and the timelines that you propose. Okay. In terms of press, here usually it's very public. You will probably have press releases. There will probably be a lot of information in the market. There will be rumors, leaks, and obviously this has a very negative effect on employees, on clients, suppliers, and the whole management of the company, because they will know that they are being sold, and this makes everyone around the company very nervous because they are uncertain about their future. Okay, in a competitive process, you might have some leaks and some rumors. Hopefully, if you manage it well, you try to limit this, but sometimes it's difficult. And in bilateral negotiations, usually there is a very reduced risk of leaks and rumors, because if you manage things properly and don't discuss it with many people, you can be able to try to manage a process without having rumors and market being aware of it. Okay. What about information? Information here is usually public. There is a lot of exposure of companies' information in the market, competitors and others. Here there can be some market information available that maybe is not ideal, but it's a give or take for having a successful process. And here you have maximum control of information, because you only share what you want and what you need at the different steps in the process. So the different types of process have different pros and cons, and depending on which company you are buying or potentially acquiring, which type of process you will have. Okay, so now I have prepared this slide where I include what a typical M&A pitch document will include. So if there is an M&A advisor, a bank, call it JP Morgan, call it Morgan Stanley, call it Merrill Lynch, Credit Suisse, Lazard, Rothschild, whatever, Goldman Sachs, whichever bank or investment bank you choose that is going to be visiting clients to doing a pitch or an M&A pitch to a client, will be discussing with them or reviewing with them these different topics. Okay, first they will do an introduction of their bank. They'll say, this is who we are, this is what we've done, this is how we are ranked, we are the best M&A advisor in the country, in the sector, in the region, we have done all these large transactions, we have the best, and then credentials in the sector, credentials in the region, credentials in the country. We have done all these previous transactions in your same sector. We have been doing all these transactions in your region, in LATAM. We have done all these transactions in Peru. We know very well your business, your segment, etc. They will present some case studies, similar to the Falabella Maestro case study, but probably in one slide or in 2 slides, to show the client that they have already managed transactions in their same sector and that they are willing to do so effectively and for the benefit of their client. For example, Merrill Lynch and Morgan Stanley that advised Enfoca on the sale of Maestro, I'm sure they used the case study to say, since Enfoca hired us, we helped them to sell very well their company, they sold at a very high price, we generated a very competitive process, we were able to close this process in 2 months, we were very successful, the company was very financially stressed and in a very difficult situation. Nevertheless, we were able to sell it very well, and the company was very well advised. And they could furthermore say, Falabella overpaid, Falabella didn't hire any advisor. Jala paid a high price for a company that was not, like they can give a lot of arguments focusing on the numbers to try to sell the benefits of hiring an investment bank, okay? Then you might discuss with them what strategic alternatives they have for selling their company. And this is what we discussed, 100%, majority stake, minority stake, etc. Some process considerations. Again, what we discussed, the different types of processes. And then you can discuss what are the objectives, what is the strategy, what are the different responsibilities that the different parties or groups have in the context of a process. And this we can see, for example, here. If we look at our timetable, you can find here throughout the whole process and the different steps that you need to go through. For example, preparation of the teaser, preparation of the info memo, how long it takes, and who is in charge of it. The investment bank, the client and the lawyers, the investment bank by itself, etc., etc. Who's in charge of doing the valuation of the company? The investment bank. Who is going to be doing the financial analysis? The investment bank together with management or the owner, the seller, which is going to be giving them some guidance on how to do it. Okay, so this is what we mean by responsibilities throughout the process. Who's responsible of what part during the sale process, okay? Then you probably discuss with your client who could be the potential buyers for their business. You are going to say, okay, you are going to sell your company. We think this and this and this player could potentially be interested in acquiring. And obviously, you don't just have to give ideas. You have to really think about it, and you have to maybe even discuss with people that know well these potential buyers and tell them and ask them how do they see the potential or their interest in a potential acquisition of this company. Obviously, this is not done directly. You don't go to the potential buyer and say, would you be interested in buying this company? You, for example, contact, if you are an international investment bank that has presence in different countries and that has bankers covering different clients. For example, if I were working at the time I was working at Lazard, I would call a Lazard colleague in the US or a Lazard colleague in the UK or in France, and I would say, which of your clients could potentially be interested in acquiring a home improvement company in Peru of this size and of this nature? And they would tell me, for example, oh, maybe Home Depot, that is my client, would be interested. Or maybe, and in that way, I could contact the different bankers in the different countries and have a very good idea of who potential international buyers could be for my client. And locally, obviously, if I'm a local banker, I would probably know better the local players, and I could know who's competing with my client, who is in a good situation to potentially acquire or not, and who could potentially be interested in my client. Okay, so you will come up with a list of potential buyers. Sometimes you don't only provide a list, you also provide some information on the buyers for the reference of your client. Also, you present some valuation references because your client is interested in selling, but they want to have an idea of how much their company is going to be worth. Because they might be thinking, look, I'm very interested in selling my company, but I want to get $200 million from my company. So they have to be realistic about the valuation that they're expecting or the value that they're expecting for the company. So you sometimes, or you usually bring some information on valuation so that at least your client takes away some referential valuation, some basic metric. For example, you can provide them trading multiples, and you can say, okay, companies in this sector are trading at 10 times EBITDA or 12 times EBITDA. They know the EBITDA of their company, they multiply it by 10, and they know a reference enterprise value for their company. If they have some amount of debt or net debt, they subtract it. And mind, when you tell them a multiple, they already know more or less how much the value of the company would be for them. Obviously, if those companies are comparable with them, but this is just reference valuations. And finally, we would probably finish the document with some biographies of the team, of the investment bankers, experience, so that they know, like, look, these people that are very well prepared will be, hopefully, would be advising you in the transaction. You will have someone participating in the Lima office, you will have someone participating in the New York office, or in the Bogota office, or depending on the nature of the transaction. And you will tell them probably, this will be the managing director in charge, it will be the director, this will be the associate, sometimes even say this will be the analysts in the transaction. So that they can see the full team, they can see that it's a small team, but very well prepared team. You can also say the experience of these bankers, in which transaction they have worked previously, if they have worked in the same sector, how long have they been working in investment banking, etc., etc. So with that and all that information, I want to show you some examples of M&A pitches. I will show you an M&A pitch, and these are going to be real documents. I will just show them, scroll through the documents so that you get an idea of what is included. And I will show you a pitch document for a sell side mandate and a pitch document for a buy side, so that you have an idea of, and they are obviously different. They are very different because in the sell side, you want to show your client, if you're a banker, that you have a lot of experience in managing process and how to structure a process and how to best generate competition in the process. And you're going to potentially say who is interested in your company, how much the company is worth, etc., etc. And in a buy side, you're going to be probably proposing or probably telling your client that you know very well the sector, that these are potential alternatives for them to acquire, and you might be trying to give a lot of information on the sector, on the industry, of your knowledge of potential transactions as well. Okay, so let me, here I think just for reference, and I will leave it in the presentation for you to see, is a slide showing valuation. This is a transaction multiple table. They're saying in this sector, if we look at, so this is again retail, this is, here we have Falabella, we have La Curaçao, we have Cencosud buying supermarkets. So this is retail sector, and these are transactions that happened between 2010 and 2013 in Latam. We have Colombia, Chile, Mexico, Brazil, Peru, US as well, so Americas, let's say, the acquirer, the transaction value or the deal value, and then a couple of multiples. The transaction value over sales and the transaction value over EBITDA. And then you have the median and the average multiple levels for those two multiples. So you would say the transaction multiples for this sector in the last 2 years or 3 years has been 0.8, 0.9 times sales and around 11 times EBITDA. So if you show a company or a seller in this sector this transaction comes, you could tell them, look, on average or median, companies in your sector have been sold at average multiples of 11 times EBITDA or a little bit less than one-time sales. So you have an idea of your own levels. The client doesn't even need to share it with you. They can just have the reference for themselves and know how much a reference value or reference valuation for the company. If you want to have the right valuation or the good valuation for their own company, you need to do a DCF, and you need to sit down with them, discuss their projections, etc. We will see in the next or in the following class. Okay, and then the other slide I have here that I will share with you in the presentation is a slide showing what we discussed here, which is the analysis of potential buyers. Okay, so you might say, okay, this is a slide on the restaurant industry, for example. And so this is a restaurant company that was being sold or that was interested in selling, and we told them, look, we see all these players potentially interested in buying you. So this could be all potential buyers. Obviously, this is a very generic slide or very initial slide, probably in an initial pitch. They're saying, okay, the strategic players that could be potentially interested in buying you could be Alsea, Nutresa, Paco Holding, Darden, some private equity firms or financial players interested in potentially acquiring you could be Catterton, TPG, KKR, and Southern Cross and others. And some family offices or others could be Bahia, Crown Family, Pritzker Family, etc. So this is a way to show very generic who potential buyers could be to a client. Okay, so with this we are done with today's presentation. I will show you an example of an M&A pitch on the sell side and an M&A pitch on the buy side. Okay, so give me a few seconds, sorry, to share with you the document. So we will see the sell side first, which I think is more in line with what we had been discussing. I will scroll through the presentation. Obviously, it's not important. The details are not important. What is important is more or less what are the type of contents that are included. Okay. So here there is an initial disclaimer, and then you have a table of contents. Introduction to the bank, the investment bank overview, why the investment bank, some transaction considerations, overview of the process, potential buyers, valuation metrics, and then the advisory proposal. And in appendix, there are some trends on the industry, some credentials of the bank on that sector, and the biographies that we mentioned. So the different topics that we mentioned in the slide. So you have an idea of what is included. Well, this is just an introduction or an approach, saying what's included in the document. And then you describe the bank, okay? In this case, you're saying what is the tradition or the philosophy of the bank, how does it differentiate from other banks, from boutiques, where are they present in all these different countries, what is the ranking compared to other banks in terms of transactions, what is their number of bankers in the different parts of the world, what are their credentials? What are different transactions that they have done in the world? What are different transactions that they have done in Latin America? So in the region, where are their offices? Where are they present? What should the shareholders or the client should be looking for in an advisor? So they are saying, you should hire us because we are independent, because we have presence, because we will dedicate resources, and the different arguments why an investment bank should be hired. what are the credentials in the specific space in the consumer business? What are the credentials or their experience in global retail? What is the experience in the specific sector, which was the restaurant industry? So they have advised in all these transactions, so should probably know how to do it in your transaction. What is their experience in Peru? And then some considerations. Some views on strategic considerations from the transaction, some views on valuation, some views on potential buyers. And what is the positioning that they see for the company? How do they see the process? Who's responsible for each part of the process? The different types of processes that we discussed: auction, targeted bilateral negotiation. How should they prepare for the process? Preparation, marketing, due diligence, the different phases. This is a sort of timeline. And then they give some information on the different parts of the preparation phase, marketing phase, due diligence, who's responsible for each part, and then a timeline. Who are the potential buyers? And this is the slide that I showed you before. And then not only this overview, but they go into detail of putting some explanation on each of the potential buyers. So, for example, for Alsea, who are they? What's their size? What are the brands that they manage? Where are they present? So you give them some information on each of the players so that they know who their potential buyers could be. In a similar way, for all the names that are mentioned in the potential buyer list, for strategic players, for financial players, for family offices. What are some valuation metrics? Here you show trading comps. What are companies in the sector trading at in terms of firm value to EBITDA by different sector: casual dining, fine dining. In Latin America, globally, in Latin America, trading comps. So you give them an idea of valuation. For example, here, if we zoom in, you say in median they are trading at 10 times EBITDA. For the different sectors, they are trading at 11 times or 9 times. So globally, in the region, they were trading at 8.5 to 10 times. So you see more or less similar levels. This is just to give you an idea of what is typically included or shown in a pitch. Then you present the advisory proposal. You say, we would charge for this transaction a success fee or a retainer fee or maybe another type of fee, additional fee. Usually investment banks charge success fees. So if you end up doing the transaction, you pay them a percentage of the transaction price, or you might set up some retainer fees in order to receive some income regardless of if the transaction happens or not. Okay, and then the appendices that we mentioned, some trends on the sector, and also I think some more credentials and the biographies of the bankers. Okay, some case studies and biographies of some of the bankers. Okay, we run out of time, but we just finished the example of an M&A pitch for the sell side. Next class, I will show you briefly an M&A pitch on the buy side, and we can then continue with next class. Okay? Please let me know if you have any questions. There were no other questions in the chat except for those that I answered during the class. So let me know if you have any questions now, or if you have any questions for next class, or you can also send me as well always a message or an email with any specific questions you might have. I hope you like the class. I hope it's interesting and it's helpful. And please let me know if you see any way in which I can improve the class, considering the way we are teaching virtually. Hopefully, get something out from it. All the best for the week, and see you next week, next class. Bye. Thank you.